Hello and welcome to Switzer. I'm Peter Switzer. The stock market has surged today on the news that US President Donald Trump has sealed a deal with Mexico, and as a consequence, no tariffs will be imposed on the state's southern amigo. The oil was closed over 90 points higher, and I guess the question is, how will stocks fly higher if Mr. Trump and Xi Jinping kiss and make up over dumplings in Japan at the G20 meeting later this month and agree on a trade deal? To discuss today's market action, we have the former CEO of CommSec and Switzer Report market tipster, Paul Rickard. Then Charlie Aitken will tell us what stocks are in and out with his Aitken Investment Management Fund. Is he still going longer Chinese stocks? That's the big question for Charlie. And then we'll hear from the CFA at a US bond fund that now is listed on the Aussie stock market that give you access to big name US company bonds, which have historically had returns around 5% plus. Well, Paul, the market got a bit of Mexican chili to high up the stock market.
Look, Peter, not often when you come on set and it's up, the market's up 100 points, a new high, the highest in more than a decade. So the bulls are cheering.
Yeah, and they're stampeding. But is it because of Trump actually cracking the deal, or is there more in this bite?
I think it's really interest rates, Peter. It's driven by interest rates in the US, interest rates here. We're following the US market. I think everyone thinks Trump was always going to crack a deal. I don't think the market's ever been that concerned. It's had a little bit of pullbacks, but look, after all, he wrote The Art of the Deal Maker, and we all think he's going to do a deal at some stage. And I think the risk is he doesn't, but the market, I think, is prepared to be a bit patient.
And you also think because he warned Mexico, then he got the deal, then he took away the threat of tariffs, that when he gets together with Xi Jinping in Japan over a few dumplings, they'll just kiss and make up, and a trade deal will come.
He's now going to do what he's told at the G20, apparently.
Yeah.
I don't think it's quite as straightforward as that, but look, Donald...
But they're friends. They're friends.
They are friends, and look, I mean, Donald said the Fed had got it wrong on US interest rates, and what's happened, he's called a few he's upped the rhetoric on trade. Suddenly the Fed's changed tack. Now we're talking about 3 interest rate decreases this year as opposed to 3 interest rate increases. The market's celebrating. We're off to the races. We're following suit. And Donald looks pretty good at the moment, doesn't he?
He sure does. Let's look at some of
I know that's going to upset some people, but that's just from the voice of someone in the market.
That's
so he seems to be able to outthink the markets a little bit.
That's right. We're not playing Democrats or Republicans or Conservatives or Liberals or whatever. The bottom line is he's getting away with it.
He's getting away
with
it, and he's winning. So I put the big caveat so far.
Okay, interesting. Vocus was being chased by the Swedes last week. They dropped out, and along comes AGL.
Yeah, so AGL's come up with an indicative bid of $4.85 for Vocus. Now, AGL did announce last week that they'd already had approached Vocus. They wanted some exclusive terms around due diligence. At the time, Vocus rejected that because the Swedes were prepared to pay a bit more. The Swedes dropped out after only, I think, 5 days. Now AGL,
no intestinal fortitude, those Swedes.
I don't know why. I mean, but anyhow, now AGL has an exclusive period of 4 weeks, allegedly, to negotiate with Vocus. Now, the market doesn't think this deal is a done deal because the indicative offers at $4.85 and Vocus shares today closed at $4.17. That's a long, long way from the alleged offer price. So, look, I don't know what it is about Vocus. I also struggle a little bit to understand the attraction to AGL. They say it's all about the power or communications and electricity and all those
It's
sort
all
of things.
infrastructure, isn't it?
Infrastructure things are coming together as there's convergence between those type of things and the skills you need to operate that with the corporate market, and the regulators are the same, and there's synergies in marketing and
you can market to the same base as well.
Apparently, and so they see Vocus and some of its investment in telecommunications infrastructure, which Vocus has done, as being a key to sort of AGL's long-term strategy. It's a little bit left field for me, Peter, but I'm no expert about power and telecommunications.
Well, I can remember at least 10, maybe even 12 years ago, Rodney Adler, when he was the boss of of what was his insurance company now?
FAI at the time, yep.
Yeah, it was F4 Insurance at one stage, wasn't it?
We're on TV, Peter, so we won't delete that, but he just meant FAI, right?
Yes, right. And I remember Rodney actually, he was conducting a lecture at one of the business conferences, and he actually said that insurance companies could get involved in infrastructure, telecoms could get involved in power, and that was something that was perceived, by Rodney and others around that time. It does make a lot of sense because AGL's got problems in growing its base, and of course the government wants to undermine its profitability by controlling energy prices. Going into another area could be a way to make money.
Well, it could be. I mean, but then the AGL board has a lot of egg on face at the moment. I mean, they were the ones who took over the government over Liddell. I mean, Vesey went. The whole AGL share price today is about down 30% from its high about 18 months ago.
Is the buy, Paul?
Oh, well, look, it probably is. The market didn't like it today, but AGL has been an underperformer. The board totally got it wrong about Liddell in terms of not necessarily the idea about wanting to close it, but how to play the politics. They mishandled the politics. The CEO went. Most of the board should have gone as well. Now they're turning up wanting to buy Vocus. It's understandable why the market's not as wrapped in this as perhaps as you're suggesting, Peter. So AGL shares today down about 7% in a market that's had its best day in a zonk. So
and Vocus, I guess, was up a bit, was it?
Vocus, of course, was up, but look, this deal will take a while to play out if it happens.
Rene Rivkin once said to me that you always or nearly always get a higher bid after the first one. Didn't work out with the Swedes,
but remember, this is not a bid; it's just an indicative offer, right?
Okay,
so, and
it's
again,
different.
I think Rene's a bit. I mean, the market telling you at 417 versus 485.
No enthusiasm.
The market doesn't believe this at the moment. It's seen the Swedish group walk away after a week. I reckon they're betting on AGL walking away, or maybe the board. Maybe there's shareholders, because AG also has got to fund this bid. It said it's going to use existing bank debt, and maybe the market's saying just we don't want you to do it.
Okay.
So I don't think that deal's by any means I don't think this is a Rene Rivkin backer in just yet.
Okay, next story. Afterpay is going to the market to raise some money.
Afterpay in a trading halt, Peter, raising about $300 million. Look, I mean, it's been a phenomenal success story about the weekend about it getting into healthcare and particularly some of the other services outside the Medicare rebate, so people wanting to get things like some various types of elective surgery and other types of higher cost, things that the Medicare rebate doesn't cover, pay by Afterpay, so the question there. But anyhow, raising $300 million in a trading halt. Also a sell down by the three founders, using this as an opportunity to sell down, so the people bidding for the $300 million also have a chance to buy the shares of those wanting to exit a little bit. And there'll be potentially a share purchase plan or something like that for the retail investors. So we'll find out about Afterpay the next day or 24 to 48 hours.
Is this company looking like a company that's got a real future,
I think
Paul?
People are starting to talk about Afterpay that way now. I mean, initially some of the highly respected fund managers saying, look, if there was a tech company, I might almost get into it. You've got to also think that Afterpay must be coming up on the radar of some of the big foreign players. I've always thought personally Afterpay was very vulnerable because it gets most of its revenue out of the fee that the retailer pays. So they charge about a 4%, what we call a merchant service fee. That is, if you go in there, Peter, and you spend $100 as a customer, about $4 of that goes to Afterpay. So the shop only gets $96. That's pretty high cost.
It's worse than Amex, isn't it?
It's worse than Amex, and it's very vulnerable, I've always believed, to someone coming in and actually sort of producing the same product at half the cost, just in terms of cannibalisation. But look, to its credit, it's expanded to the US, it's tapped a new market, the fact that it's finding new fields and growing, the market's starting to like the Afterpay story. I'm not sure I'm there at about $24, but the market's saying maybe of any of our tech stocks, this is the one you'd look at.
I got to say, deep down, there's a certain sense of pride because our last two stories, I taught Vaughan Bowen, who is the founder of M2, who's now in Vocus, and also Anthony Eisen, the chairman of Afterpay. So they were really well taught.
You have to say that Afterpay have done a really good job, right? To their credit, and so I guess that's one of the reasons the market is still pretty supportive.
Okay, Prosper listed today.
Yeah, Prosper's the small business, one of the small business lenders out there. Book size is only about $350 million. Now, to bank That's pretty small in terms of loans, but they're the leader in that field. They charge a pretty big interest rate, so it's about 22, 23% on average. Yeah. Anyhow, Prosper listed about 20% of its shares. They were issued at a price of $3.75. Finished trading today at $4.46, so that's about a 19%.
They've been drinking
premium.
champagne tonight, I'd say.
Drinking champagne. Values the company at almost $600 million. Sure. So, look, they've done well, and again, I guess they were sort of the first mover in this space, the first to list it. This wasn't a big public offer, Peter. This was just placed to a few institutions, but it does show you there's a bit of demand for that stock, and I guess in a market which is at all-time highs, people that are able to demonstrate growth, and Prosper has been growing very rapidly, the market will back those type of growth stocks for a little while.
Finally, Star, it's losing its sparkle.
Until you do a downgrade. And look, I'm not saying Star's a growth stock, but this is, on the one hand, the market is so, I don't know what the word is.
Out of love?
It's in love with some, out of love with others, and when you disappoint, you pay a price. So Star came out today with a bit of a downgrade. Not a big downgrade, they're just not getting the revenue growth. So that EBITDA is going to be about $10 million less than last year. The share price fell 16%, down to $3.80.
Seems excessive, doesn't it?
Well, it does seem excessive, but we've seen that with stocks that downgrade, that the market is very unforgiving and not quick on the rebounds. I mean, we could have made the same case about Link last week, Peter, and I liked Link, but to the same reason, it hasn't rebounded, and it's tended to drift low. So the market sort of, I mean, history shows you, and this is what you're fighting against is, and a lot of analysts will tell you this, is the first downgrade is really the last. It's usually the start of a cycle, and so the analysts and the market have learnt, and they're very punishing, but. So, you know, if you disappoint at the moment, you pay the price. So this is what you've got to remember. If you're buying stock on big PE type earnings, and there are lots of stocks out there at the moment trading at very high multiples. We're in a bull market, right?
Yeah.
I haven't seen the market this euphoric for a little while, right?
That's right.
I mean, not the type of taxi driver saying, you know, or the Uber driver is probably these days riding the taxi driver. You get asked what stocks you like, but we're getting close, Peter. We haven't been this high. We've seen it across the market, almost every sector up, every stock up, a couple of those that disappoint. And Star Cop was one of those today, and it paid the price.
Okay, so one last thing, Paul. Today we saw that the business confidence has rebounded. I guess you put it down to the ScoMo effect and the surprise election win?
Yeah, surprise election effect. I mean, business confidence. I don't think things are as gloomy as they're made out to be. I mean, as soon as... I have to admit, I'm not a huge ABC fan, but yesterday's ABC... what's that silly
Insiders?
show? Not the Insiders. I watched that on the weekend, Pete. But the one, the comment show they have before the national news. No, the one.
The Drum.
The Drum,
okay.
And the Drum, of course, program yesterday was a business special. And it was all about doom and gloom in the economy. ABC's moved off the housing cycle. Now we're onto the economy, and it only grew by 0.4% the last quarter, and this is a tragedy. I don't think things are as bad as they've made out to be. I think you've got to remember also that the GDP figures. The agricultural sector's in recession, and that's impacting the growth numbers.
And drought's the issue there.
It's the big issue.
You can't blame ScoMo for the drought.
But, you know, things aren't quite as bad as people are saying, and I think that's why we're seeing, you know, business confidence rebound. We always said the election was going to be tough, right? We know elections are really bad.
And it's bad for the economy.
Bad for the economy. They hurt every time. People defer major purchases. They defer taking out new loans. Things slow down. That's what you'd expect to happen in the last quarter ahead of an election. I think we're getting the rebound of the post the election, and I wouldn't be surprised if the growth figures don't get a little bit better coming here on. That's my economist view, Peter, about the economy.
And it seems to me like the June quarter still could be subdued because it's got the election effect in there. But after that, I do think because you've got interest rate cuts, tax cuts, infrastructure spending, a lower dollar, there's that first home buyer assistance program. It's all going to add up to a stimulus that should help the economy, provided Donald comes up with a trade deal.
Well, there are a lot of very wealthy investors with share portfolios tonight. Superannuation returns for this year are going to be fantastic. You know, this whole wealth effect, which we've seen mainly because of the property side, it can turn around really quickly. And I think people forget how important the wealth effect is to confidence, both consumers and business, and it does show up in those figures down the track.
Without a doubt. That's Paul Rickard. If you want to read Paul, go to the Switzer Report, and that's switzerreport.com.au. Coming up, Charlie Aitken, looking at how he's investing right now, and I want to know whether he's still keen on Chinese stocks. Well, it's been a good day on the market today. Let's talk to a guy who lives and breathes stocks 24/7. Charlie, thanks for joining us.
Thank you, Peter. Yes, good day in Australia and the whole region, actually. A lot of green around.
Would you have expected this kind of reaction to... Is it primarily the Mexican solution, or is it more, Charlie?
Well, it's a little bit of everything. It's central banks and the perception that they've got our back. The Fed might cut rates, Reserve Bank just cut rates, Bank of New Zealand cut rates. So there's that perception. It's also positioning as well. People were quite bearish. There was a lot of people with a lot of cash, a lot of people with a lot of shorts on, and that hasn't quite worked out. And I suppose when you look at the Mexican solution of the weekend, it makes people realise that Trump probably does want to do a deal with China. He even tweeted last week it was the best week of the year for the Dow Jones Industrial Average, so he obviously watches the share market too. So, and plus valuation stage, you got a bit cheap as well. So there's numerous factors. As I said last week on the Switzer webinar, I think this probably continues.
Okay, let's look at some of the stocks you've been talking about. Last week you talked about BlueScope. Let's just tell us why you think BlueScope looks interesting at this
Well, I
point
haven't
in time.
bought it yet, but there's a sort of stock I'm looking at now. When markets have pretty much rebounded most of the losses of May, give or take. So I'm looking for things that have underperformed, things that look like good businesses, things that their underperformance looks unjustified. So I said last week, I bought some A2 milk, which I thought was oversold. They've recovered it nicely. I mean, I'm looking at things like BlueScope that have been badly left behind and seem to be a consensus short, consensus negative view out there. But look, it's harder in Australia because the vast bulk of things have bounced very hard. I mean, the Commonwealth Bank is over $80 today. Pretty much everything's up sharply. So I'm now looking at those laggards. I think BlueScope is interesting, but I haven't bought in the fund yet.
Okay, A2, a lot of people would be curious. This has been a very good company, but basically got cracked because of the Chinese sort of changing the rules, or allegedly changing the rules.
Headline on potentially changing the rules, but you would have seen over the weekend 3 Chinese warships in Woolloomooloo in Sydney, and what are they putting on the warships? Baby milk powder. I mean, seriously, it's just quite unbelievable.
Okay.
So look,
nice leg up for A2, isn't it?
Look, I just think that I think A2 is a great business. I think the demand for infant formula out of China won't change. I think the stock will get back to $15 or $16. And generally when these headlines happen out of China, not much happens after that. So I think that one will be okay. It's back near $14 today. Got below $13 the other day. I think they're fine. I think they'll have a decent result in August. And I think what we're trying to do in the portfolio in my fund is actually just look for companies that are going to report well. And I don't think there's any change to A2's outlook. One
company you always liked, basically until the trade war talk came along, was Tencent. Tell us why you've always liked Tencent, because you still like it, don't you?
Yeah, no, I've had a big go at Tencent down here. Actually, the share price fell about 20% in recent times, mainly because foreigners were just selling anything to do with China. It's a huge weighting in China.
Because of the trade war issue.
Sell first, ask questions later. Look, I think it's a monopoly way of communicating in China. It's also, it commands about 50% of the cashless payments in China through WeChat Pay as well. It's also a video gaming exposure as well. To me, it's like buying an exchange-traded fund over Chinese tech. It's got a little bit of everything. There's probably no reason to diversify from that, but the share price pulled back sharply in the last month, so I've doubled our position in that, and I think that'll be a good investment. It's back to about 345. Hong Kong, I think it could go to 400, so I think there's much more upside than that.
Yeah, and so if a trade war deal is struck, you'd expect a company like this to be one of the first they go chasing.
I think all things China would bounce hard on that. But you've got to remember that Tencent only operates inside China. It's not an exporter of anything. It just deals with the Chinese consumer market domestically. So that and Alibaba, I think, would have tremendous upside on a trade war deal being done, which I actually think it's coming. I feel that there's going to be something done here, but the stocks are still priced quite negatively. So things like Tencent, Alibaba, even BlueScope to a degree, have still got a pretty big trade war discount in them. I think it's time to buy those.
Okay, Microsoft, you've always liked Microsoft as a fairly big holding in your...
Yeah, it's one of the biggest holders.
Why do you like Microsoft?
I think it's just a fantastic company with a huge embedded installed base.
We're all stuck with using it.
We're correct. I mean, I think 1 billion people a day use their product. It's all installed in terms of Office. I still like LinkedIn. That's another great communication advertising mechanism. But the stock, even near $1 trillion valuation, is growing at 15% per annum. Buying back its shares has a tremendous balance sheet, great leadership, and a very, very dominant position and a wide moat, as we say. And Microsoft made a fresh all-time high yesterday, and probably continue. Many US stocks that hasn't really been reported made fresh all-time highs last night. So look, I think they'll have a good result coming up in a month or so. I think that it's cheap versus its earnings growth, and it's just a great business.
How do you work out whether a company's going to have good results or not? You can't just put your finger out the window and
Well, to be honest, it's a bit easier in America. They report every quarter.
Yeah.
So not much changes in 3 months. It's unusual for a big change in a business like Microsoft. I think that you're probably not going to get a huge surprise out of it, but it delivers the analyst expectations and better. Well, that's okay. There's consistently a game in America of beating and raising analyst forecasts. So the companies try to temper the analyst forecasts and then beat them. So look, I think they're very predictable stocks, the large cap US tech stocks. They're quite easy to forecast and quite easy to analyse. I think we can analyse them in our own lives. So for me, the quarterly reporting thing's an advantage. You find out every quarter.
Yep.
But there's also some quite large predictability about these businesses. So I just think they're great businesses.
What about Apple? You've liked Apple recently?
No, I've had a go at Apple. They got down to $172, got oversold. They're back to about $193, $194. I think they're cheap. I don't think there's going to be reprisals against
Are you buying more or are you
Yeah, I
happy?
bought more. No,
Yeah.
I've bought more. Most of these big US tech stocks and Chinese tech stocks I've had a proper go at in that sell-off.
And the trade deal's going to be
we
critical
had cash.
to you.
We had quite a bit of cash on the sidelines, but there's no point being in cash when cash rates are zero. That when you get these pullbacks in equity markets, you've got to do something constructive. And we just went and bought the best tech stocks in China and the best tech stocks in America.
Okay, you got out of a favourite stock of yours in Aristocrat Leisure. Why did you do that?
Basically valuation. We thought there was less upside in that than other stocks, including things like Tencent, Alibaba, Apple Computer Company, Microsoft, Visa, all these big global names. We thought there was more upside than Aristocrat at these prices. And we weren't completely convinced on the composition of Aristocrat's earnings. We thought they were going to be more digital and they weren't. So for us, it's always about working the capital in the portfolio as hard as possible. We have a global mandate. We don't have to be stuck to anything. And when you've got a stock that's done well, we do tend to reduce it or even sell out of it to go and find something else that we think can do better from there. So it was an absolute and relative call on Aristocrat, but we just think there was that opportunity that came in May in the big sell-off in leading companies globally gave us a chance to go and sell some Aristocrat and put money to work globally.
Would you go to cash if you got spooked?
Yes, I think cash is the best.
If the trade war looked like it was going to get worse and worse.
Yeah, but look, at the moment, I feel very comfortable being fully invested. We are absolutely fully invested right now and put a lot of money to work. About 25% of the fund was cash in May and we went to pretty much zero cash because we think the market was paying us to take the risk in some of these big global stocks. Pete, there's nothing wedded. Like you can always change your mind. You can move quickly as a smallish fund. But yes, the best hedge in the world is cash if you are worried about things. But I'm not worried about things quite at this moment. I think there's more upside in markets and I think the chances of a trade deal are increasing on China.
Okay, just imagine someone's watching this who've become relative novices to investing. What do you think is the most important lesson you've learned along the way that drives the way you invest?
Ignore noise, back yourself, try to be a little bit contrarian. On those bad days, buy something. On the very good days, sell something. Don't fall in love with anything and just buy the best companies you can and hold them for as long as you can. You know, the temptation to buy lower quality stocks, value stocks or second quality stocks is ever present. But if you stick to the biggest, best companies, you generally do very well. And you can even see in Australia that today it's things like CSL, just up 4% on the day. You know, the market comes back to these big global leaders when it decides that they are good investments. So look, I just think, keep it simple, Pete. I think that's the key to everything. Keep it simple, keep it large cap, keep it understandable.
Okay, mate. That's Charlie Aitken from Aitken Investment Management. And coming up, we'll be talking to the CFA of a company called Neuberger Berman. And they invest in US companies, in the corporate bonds, and they've done pretty well, and they're listed on the Aussie market. Thanks for joining us on Switzer.
Thank you.
All right, so why don't you explain to people watching the program now what your fund is all about?
Sure. Our fund has a very simple premise. Our objective is to pay a distribution monthly on an even basis with our current target of about 5.25% per annum. We do this by investing in the bonds of global companies. So we have almost 300 different issuers in the portfolio. A lot of these are household names people have heard of, whether it be a Levi's or Netflix, but they're also businesses people understand, like cable companies and health hospitals.
So, in a sense, you've got 300 well-known companies, if not here, and many of them are not well-known here, but definitely in America.
Sure.
And they issue bonds. They want to borrow money,
Mm-hmm.
and they borrow it at a particular percentage, and that percentage is all rolled up to give a single return to people who invest in your fund.
Correct. And I would say also it's a global portfolio. So it's roughly 60% in the US, 20% in Europe, and 20% in emerging markets.
Yeah.
These are all bonds that are rated by one of the three major agencies. As you mentioned before, they're fixed rate in nature.
Now, could be a hard question, but have you ever lent money in a corporate bond to an Australian company?
We do have one issuer in the portfolio, a company called Fortescue, which I think people know and
they all know
understand.
that.
And it's because it's a larger company. For us, the median revenue of the companies we invest in are roughly $6.5 billion. Median earnings are roughly $1.4 billion. So these are larger enterprises that do require to go to the global bond markets to fund their operations.
Okay. How long have you guys been doing this?
Since the late 90s. And we have over 60 billion of funds under management in terms of just non-investment grade credit.
Yeah. And what has been your footprint in Australia until recent times?
So, in terms of our footprint here, we've been here since 2007. More on the institutional side. So we manage over 7 billion of fund under management for some of the institutions here in Australia. We launched a fund in September of last year, and this was our first foray really into the intermediary and retail market.
Yeah, so what institutions are we talking about?
So some of the well-known ones here, like a Sun Super, MLC Super.
Okay, so they used to get it because they were big institutions. Now retail investors can access your portfolio of corporate bonds.
Correct. This is through our listed entity at Neuberger NBI, which is Neuberger Investment Trust.
Okay, so why don't you tell us how that operates here in Australia?
So, we listed on the ASX. It's a closed-end vehicle, which is good because we're not necessarily a forced seller or forced buyer. So we could deploy those proceeds, which we did within 2 days, invest in a portfolio of bonds, and almost immediately generate income for our investors.
Yeah, okay. And because it's on the stock market, people can get in and get out basically
Correct.
Like any other stock in the market. Okay, so talk us through, why should fixed income be considered by investments when they're looking to construct a portfolio?
Sure. Look, we believe that fixed income belongs in any balanced portfolio. And within that fixed income allocation, this deserves a place in there, given a few things. One, it's very high yield, for one thing. Two, shorter duration in nature, meaning it's less interest rate sensitive.
Yeah.
And three, it's very diversified. So we think that those three attributes really are something that investors should have. Okay,
what's the typical yield that this fund's been producing over time?
Well, I mean, for the next 12 months, we're expecting at least a 5.25% type distribution.
Okay, you said diversification. Explain how you're diversified.
We do it a few different ways. First, it's number of names. So there's 300 names in our portfolio. And so that's one where there's no individual issuer that can really impact it too greatly. Two, it's diversified by geography as well. So it's split across the US, Western Europe, and emerging markets. And in those emerging markets, there's over 30 different countries. And three, it's diversified by industry as well. So there's over 30 different industries as well represented in the portfolio.
Were you happy when you heard that the Reserve Bank of Australia had cut interest rates?
It certainly does help. If you own a portfolio of fixed rate bonds, lowering rates certainly helps.
Yeah, so you become more likely to be on investors' radar screen because of the rate cut.
Correct.
Okay, so we're currently in a low investment environment. Should an investor approach a portfolio construction around this time?
We still think so. We believe that fixed income, and most notably a fund like ours, deserves a place in investment portfolios. So
NBI is doing a capital raise. I want you to explain what a capital raise is for a lot of my viewers. They wouldn't understand exactly what it is. And what does it say about your confidence in the market right now?
Yeah, look, so we did our initial capital raise in September of last year with good investor demand, raising over $400 million. And we were able to deploy those proceeds within 2 days. Our market trades almost $20 billion a day.
So some people missed out.
Yeah. And since that time, our share price has traded at a premium to our net tangible asset, indicating good latent demand within the market. And as we come out here quite regularly to meet with existing investors, we met a lot of people who either missed out or people who wanted to participate more. And so we're out with a entitlement offer which gives existing holders the ability to purchase more shares. And if there is a shortfall there, we can issue additional money for the shortfall as well.
And what are you hoping to issue in this capital raise?
Roughly over $400 million as well.
Okay, fine. How is the MBI different to other fixed income listed offerings that you're competing with?
When we look out in the market, we're the only global manager investing in bonds of global companies. So when we look at some of the other offerings in the market here, a lot more domestically oriented, not necessarily investing in bonds.
And effectively, you're offering an opportunity for investors to go global in their investment in bonds, particularly, as you say, we have an inclination towards domestic investments.
Correct.
Okay, so to finish off, a lot of people who haven't thought about investing in bonds overseas, what does it think that are the key characteristics of the global high yield market?
Sure, a few things. One, it's large in size. It's almost 2.7 trillion in market value and spread globally. It's roughly 60% in the US, 20% in Western Europe, and 20% in emerging markets. It trades quite frequently, almost $20 billion a day. A lot of new issues, almost $400 billion per year in new issue. And so it's one where it's able to create a portfolio across a lot of different names. There's almost 1,500 issuers in the market to generate a good total return for investors.
I always lie when I say final question, because in listening to one answer, I need to ask another question. How many defaults have you had in the history of your fund?
Since inception of our overall strategy, we've had one unanticipated in default, and that was a result of fraud. Since then, we've done a good job of really mitigating the downside risk within the names in the portfolio. One of our jobs as a manager is really to assess each name, and if we are getting worried on a name or an industry, we're able to sell out of that name quite quickly. That's sort of the benefit of being in a large market that trades quite frequently. You don't have to own it until maturity or bankruptcy. You can get out early. And
the important point is you have 300 in your portfolio.
Correct.
So it waters down the potential threat of a bad performance.
Absolutely. That's how we mitigate the risk as well.
Great stuff. Thanks for joining us.
Great. Thank you.
That's the show for this week. Thanks for joining us on the Switzer program.